Global trade is facing headwinds, tariffs are disrupting markets, creating uncertainty for investors. You see the headlines. Your portfolio might be feeling the heat. It's easy to get caught up in the fear. But remember, successful investing requires a calm and rational approach. Market volatility is a fact of life for investors. Tariffs introduce an additional layer of complexity. These trade barriers can impact company profits, disrupt supply chains, and fuel inflation. This uncertainty can lead to wild market swings, leaving investors feeling anxious and unsure of their next move. It's important to remember that market downturns are a natural part of the economic cycle. While tariffs can exacerbate volatility, they don't change the fundamental principles of sound investing. By understanding the potential impact of tariffs and adopting a disciplined approach, you can navigate these turbulent waters and emerge stronger on the other side. The key is to avoid making rash decisions based on fear. Instead, focus on time-tested principles like diversification, long-term thinking, and staying the course. By sticking to your investment plan and making strategic adjustments, you can weather the tariff storm and come out ahead. Are you terrified of losing everything in a market crash? When markets tumble, it's tempting to hit the sell button. But panic selling is rarely the answer. In fact, it often exacerbates losses. Emotional decisions can derail even the most well-thought-out investment strategy. Think of it this way. Selling your investments at a loss locks in those losses. It's like selling your house for less than you paid for it just because the real estate market is experiencing a temporary downturn. Instead of giving in to fear, take a deep breath and remember your long-term investment goals. Market downturns are often followed by periods of recovery. By selling during a panic, you risk missing out on the rebound. History has shown time and again that markets are resilient. They have a remarkable ability to recover from even the most challenging events. Instead of reacting emotionally, focus on what you can control, your investment strategy. Review your asset allocation, rebalance if necessary, and consider opportunities to buy quality assets at discounted prices. Remember, market downturns can present excellent buying opportunities for patient investors. Rebalancing is the process of realigning your portfolio back to its target asset allocation. This involves selling assets that have performed well and buying assets that have lagged. Rebalancing helps maintain your desired risk level and capitalize on market fluctuations. For example, let's say your target asset allocation is 60% stocks and 40% bonds. After a market downturn, your stock allocation might drop to 50%, while your bond allocation increases to 50%. Rebalancing involves selling some of your bonds and buying more stocks to return to your target allocation. This might seem counterintuitive at first. Why sell assets that are performing well and buy assets that are down? The answer lies in the principle of buy low, sell high. Rebalancing forces you to sell high and buy low, potentially enhancing your returns over time. Rebalancing also helps manage risk. By trimming your winners and adding to your losers, you're essentially reducing your exposure to assets that have become overvalued while increasing your exposure to assets that may be undervalued. This disciplined approach can help you navigate market volatility and stay on track to reach your financial goals. When economic uncertainty rears its head, investors often seek refuge in safe haven assets. Bonds, particularly U.S. Treasury bonds, are considered a traditional safe haven. Gold, a tangible asset with intrinsic value, also tends to shine during turbulent times. Bonds, especially high-quality government bonds, are seen as a safer bet than stocks during periods of economic instability. They offer a steady stream of income and tend to be less volatile than equities. In a tariff-fueled market downturn, bonds can provide stability to your portfolio and cushion the blow from falling stock prices. Gold, often viewed as a hedge against inflation and economic uncertainty, can also play a role in your portfolio during turbulent times. As tariffs can contribute to rising prices, gold's value may increase as investors seek to protect their purchasing power. However, it's important to remember that gold prices can be volatile as well. Allocating a portion of your portfolio to bonds and gold can provide diversification and potentially mitigate losses during market downturns. However, the ideal allocation to these safe haven assets will depend on your individual risk tolerance, time horizon, and overall financial goals. Consult with a financial advisor to determine the right mix for your specific situation. Section 5. Scrutinizing your stocks. separating the wheat from the chaff. Market downturns can expose weaknesses in individual stocks. It's an opportune time to reevaluate your holdings. Ask yourself, would you buy these stocks today? If the answer is no, it might be time to consider selling, even if it means realizing a loss. Focus on companies with strong fundamentals, solid balance sheets, consistent earnings growth, and a competitive advantage. These companies are better positioned to weather economic storms and emerge stronger on the other side. Consider whether your portfolio is over-concentrated in any single sector, especially those most vulnerable to tariff impacts. Diversification is key to managing risk. Ensure your portfolio is well diversified across different sectors, industries, and geographies. This reduces the impact of any single stock or sector on your overall portfolio performance. Remember, don't put all your eggs in one basket. Market downturns can create opportunities to buy quality companies at discounted prices. Consider adding to your positions in companies you believe in for the long term. But remember, thorough research and due diligence are crucial before making any investment decisions. Section 6. Advanced Protection Strategies. Shielding your portfolio from further losses. For investors seeking additional protection during periods of heightened volatility, advanced strategies like put options and bear put spreads can be considered. These strategies can help limit downside risk but require a deeper understanding of options trading. Put options give the buyer the right, but not the obligation, to sell an underlying asset at a predetermined price, known as the strike price, within a specific time frame. Buying put options on individual stocks or market ETFs can act as a form of insurance, protecting your portfolio from further declines. However, it's important to note that options trading involves risks and complexities. The cost of buying put options, or the premium, can erode returns if the market moves favorably or stays flat. It's crucial to understand the mechanics of options trading and consult with a financial advisor before implementing such strategies. For investors seeking a more cost-effective approach to downside protection, bear put spreads can be considered. This strategy involves buying and selling put options with different strike prices, creating a range of protection. While offering limited profit potential, bear put spreads can help mitigate losses during market downturns. Section 7. Buying the dip. Turning market downturns into opportunities. Market downturns can be unnerving, but they also create opportunities for savvy investors. Buying the dip refers to purchasing assets after a price decline, with the expectation that the market will eventually recover. This strategy requires patience, discipline, and a long-term perspective. One approach to buying the dip is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. By investing consistently over time, you buy more shares when prices are low, and fewer shares when prices are high, potentially lowering your average cost per share. Another approach is to use a tiered system. This involves investing larger sums as the market falls to predetermined levels. For example, you might invest 10% of your cash at a 5% market decline, another 10% at a 10% decline, and so on. This approach allows you to deploy capital strategically as opportunities arise. Remember, timing the market perfectly is nearly impossible. Buying the dip is not about predicting the bottom, but rather about taking advantage of market fluctuations to potentially enhance your long-term returns. Section 8. Learning from past mistakes. The path to investment wisdom. Experience, even when it comes with losses, is a valuable teacher. After weathering a market downturn, take the time to analyze your portfolio's performance. Identify what worked well and what didn't. Understanding your past mistakes can help you make better investment decisions in the future. Did you panic sell at the bottom, locking in losses? Did you hold on to losing investments for too long, hoping for a rebound? Were you over-concentrated in a particular sector or stock? Identifying your mistakes can help you avoid repeating them in the future. Diversification, as mentioned earlier, is paramount. A well-diversified portfolio can help cushion the blow from market downturns and reduce the impact of individual stock or sector performance. Spreading your investments across different asset classes, sectors, and geographies can help mitigate risk and enhance long-term returns. Prudent risk management is also crucial. This involves understanding your risk tolerance, investing within your means, and avoiding excessive leverage or using borrowed money to invest. Remember, investing involves risk, but by managing risk effectively, you can increase your chances of success. Section 9. Weathering the storm and emerging stronger. Market volatility, whether fueled by tariffs or other factors, is an inherent part of investing. By adopting a disciplined approach, focusing on the long term and learning from past mistakes, you can navigate these turbulent waters and emerge stronger on the other side. Remember, successful investing is a marathon, not a sprint. It's about staying the course, sticking to your investment plan, and making strategic adjustments along the way. By tuning out the noise, focusing on your goals, and adhering to time-tested investment principles, you can weather any storm and achieve financial success. Stay informed, stay disciplined, and stay invested. The markets will reward your patience and perseverance in the long run.